Interest rates. So we had a volatile week. We had a lot going on, and interest rates are rising. Okay, to most people, that's like ho hum, boring. Who cares about interest rates? So wait, instead of paying 21% on my Visa, I'm paying 23%. Whoop-de-doo, I'm getting screwed either way. You know.
Okay.
So no one really cares about that, or like your mortgage. They should care, or the mortgage. They're like, oh, it's not a 3% mortgage anymore. It's now a 5% mortgage. Who cares? I'll just buy a less expensive house. Whatever my payment, whatever I can, $3,000 a month or $2,000 a month. That's what I'm doing. So people don't really think about that impact. From an investing perspective, interest rates have a big impact on the world.
Well, and on the economy too. Yeah.
And absolutely on the economy, which then impacts the world. So from a personal perspective, yes, I understand. We all find interest rates boring. They suck. We don't like them. They make our cars more expensive, our houses more expensive, our credit cards more expensive, student loans more expensive. I get it. That's probably the 4 big places we use interest rates. All right? Mortgages, student loans, cars, credit cards. But from a bigger picture perspective, for someone who is listening to this podcast and says, oh, I want to learn about business, I want to know about business, you need to know about interest rates, people.
Yeah.
The bond market is a multi-trillion-dollar market, okay? Bigger, arguably, if I'm not mistaken, I believe this is correct, bigger than the stock market. The bond market is bigger than the stock market. Companies and human beings borrow more money than they do raise money in the equity markets. I believe that's 100% accurate. Because if you think about it, like every company has, every large company has billions of dollars outstanding in debt. Every big country has billions of dollars outstanding in debt. They have no equity, obviously, because they're a country. Not every, but many Americans and Western people have a decent-sized mortgage of $100,000, $200,000, $300,000. You wrap all those up, and that's a bond market. It's called the mortgage market. So the municipal market, every small municipality, City of Chicago wants to build an airport. Let's borrow money. They don't do equity. So the bond markets are way bigger. Yes, they don't offer S&P returns of 10 or 11% a year long term. They're lower than that. They're going to be 3, 4, 5%. But that's still something to potentially have in your portfolio. So the interest rate market, the bond market, interest rates rising has a huge impact on the economy. I think everyone should know about this. And the first thing I want to say about this is good. It's good long term that rates are rising.
And why do you say that?
Because for the longest time, they weren't rising, which means people who trade in the bond market were thinking, I don't think we're ever going to have inflation again. I don't know if the Fed's ever going to raise interest rates again. You see, the purpose of raising interest rate, the purpose of rates go up. One main reason rates go up is because bond investors believe there could be inflation coming. The Federal Reserve is wanting to slow down economic growth. And so the bond market has been like, yo, there is no reason to raise these interest rates. There's no reason for us to move the bond markets in a way where rates rise. So we're just going to leave rates where they're at. And that's where they've been for like almost a decade after the crash.
Yeah.
And now, as we speak, this is the first time in almost a decade, rates are starting to rise. I'm not going to lie. I was kind of spooked out for a while. Like, are rates ever going to go back up? Are we going to a zero-rate environment?
Right.
Japan's been in a zero-rate environment for decades, it feels like. And their economy is definitely struggling.
Yeah.
So long-term, this is good.
Right.
It makes me feel warm and fuzzy inside.
And it's probably also because of the whole quantitative easing. That's
it.
That's
the main part of it.
Yeah. So that's going to, certainly impact.
It stops. That's going to impact it. It may even be getting unwound at some point in the near future. Maybe not. I don't know. I think it would at some level.
Yeah.
But really, I think it's bond market investors in this multi-trillion-dollar market. These investors who look at the bond market and trade it are saying, looks like we got some real growth, y'all. We might have some inflation.
Well, don't you think the Fed drives the interest rates? I mean,
on the short term, yes. On the short end, yeah.
Doesn't it all? Don't you think it all sort of stems from the Fed?
Yeah. The Fed and their communication is definitely going to impact the bond market overall. Whether you're talking about 1 month rates, 3-month rates, 1-year rates, 5-year rates, and all the way out to 10 and 30-year rates, the Fed is going to impact all those for sure.
Yeah.
However, 10 and 30-year rates sometimes will totally behave separate from the Fed. Like if the Fed is saying, yeah, we're not worried about interest rates, we're going to leave them down here really low, but bond investors are like, you're crazy, Fed. We've got a lot of growth in this economy. Trump keeps cutting taxes. Technology keeps innovating. New iPhone, new iPad. This economy's going gangbusters. You better believe that longer term rates are going to rise because they're worried about inflation.
Right, and they're probably also worried about debt levels too, because the huge deficits. So it's like if the U.S. has to keep raising more and more money by selling Treasury securities, that's going to increase supply of the bonds, which will then drive up rates.
Exactly, yields will have to go up.
Yeah.
Bond market investors will demand more percentage from the U.S. government if the U.S. government keeps blowing up these deficits, which they are.
Right. And then the rates go up, so the dollar increases in value. So then all these countries that had dollar-denominated debt, they get screwed over because they have to pay their debt back in dollars.
Hey, Mark,
Yeah.
who's running the fucking podcast?
You keep telling me to interject. Yeah. All right.
I love
All
it. I love it. You're making it so rich.
All right.
Exactly.
Okay.
The dollar gets impacted too, which is hitting emerging market economies right now. In fact, all global economies. Yeah. So which in turn hits bond markets more. Yes. No. Exactly. That's really insightful. I think the takeaway for someone who is an investor in the market, a casual investor, is, hey, there's some good news long term here. Continue to believe in investing and feel comfortable investing. Short term, however, I have a whole different perspective. Okay?
Mm-hmm.
Short term, my conclusion is this. Because rates are going up, because they've been so low so long, slow your roll on what you're investing.
Mm-hmm.
So if you're thinking, yo, I got a bunch of money and I want to put it all in now, no, don't do that. Not only are we really frothy and at the top of the stock market or very, very rich levels, with rates rising in a way they haven't risen for 10 years, that is going to be a drag on growth, a drag on the economy, a drag on your average company. The economic output of the United States is hugely dependent on interest rates. Hugely. For example, Meyer, do you guys have a credit line by any chance?
I mean, yeah, you could say we have a credit line. Yeah.
You and just about every other company in America, probably the world, have a credit line of some sort.
Yeah.
And do you pay an interest rate on that credit line?
It's fixed right now, but it will when the fixed period ends, then yeah, it'll definitely go up given the rate environment right now.
Absolutely. Everything for companies in America will get more expensive. This is why interest rates are quite, they're so essential to the economy. It's insidious almost. It's insidious. It's almost like you don't smell it, but it's happening. Your interest expense goes up. And so a company like Meyer, who was paying, whatever, let's say $5,000 a year in interest, suddenly they're paying possibly $7,000 or $8,000 or $10,000. Now think about that on a larger scale, a whole economy. Companies who borrow billions, countries who borrow billions, anyone, mortgage borrowers. Let's say we all bought a house and we're paying way more. So everything gets more expensive when interest rates go up. This is super, super important. So for the longest time, interest rates were not going up. They were just going down or staying close to zero. And nothing was getting more expensive for a long time, which has kind of driven lots of growth in our economy. And right now we've got unemployment rate at 3.7%. Wacky.
Right.
But that can't last forever. And things are starting to shift as rates rise. Everything's starting to get more expensive. It sucks. And so I'm saying stock markets will definitely globally get hit because of this. They will no doubt get hit because of interest rates rising. So on a short-term basis, 1 to 2 years, I'm saying continue to invest a portion of your income in the stock markets. Do it. Long-term, you need to plant those seeds now. I don't care what level the markets are at. You need to plant those seeds. And keep some powder dry. As you watch the economy, I'm calling it. I think a recession's coming. I don't know if it's 6 months. I don't know if it's a year. But don't put all your money in the market right now.
Right.
That'd be the dumbest thing you can do, I think. It would be more like waiting and just watching. In addition, this is the kind of environment where, you got to think about, all right, if there's a shock to our economy, right? Is it going to be a positive shock or negative shock? I don't think it's going to be a positive shock. We just passed a huge tax reform, right? I doubt another big tax reform is coming in the pike in the next 12 to 24 months. No way. I can't see that. It's not like the Fed's going to just start dropping rates. They're going the opposite direction. So if anything, God forbid a terrorist attack.
Right.
God forbid the trade war becomes a real war with China.
It's getting there.
Those are negative shocks. And so good thing you had some powder dry, because the first thing that's going to go is the stock market. And if that thing drops 25, 35, 50%, that's when you want to start putting that money in. So what I'm saying is invest small amounts, do your regular kind of whatever, $100 a month, $1,000 a month, whatever you can afford, but keep powder dry is what I'm saying. Because even though long-term rates rising is great, short-term, be on the lookout. We're vulnerable. If there's a shock that comes, the market's going to take a hit. You'll have a chance.
Do you say rising rates are great because that's a sign of a growing economy and the need to sort of slow down? Is that what you say?
That was the first point. Yeah. Of like long-term, big picture, rates rising is a good thing. It means bond investors are like, oh, okay, all right. Well, it looks like this American economy is finally back going and on its feet. It's starting to, propel along.
Yeah. And it'll also, another negative impact on stocks from the rising rates is that bond investors or more investors will sell stocks to then put their money in bonds to get the higher rate.
Great point.
Yeah.
Yeah, stocks will look less attractive from that perspective as well. Yeah.